Exam study tips and formula review, and I will be hosted by myself, Frank Salatis, and Kay Weiss.
Good morning, everybody. I just wanted to pop in and also give you a welcome. So sorry to interrupt, Frank, and please continue.
Okay. Well, Kay and I have been working together on providing information that will help people get ready and pass the PMP exam. What we're interested in is not just getting you to pass the exam, but really to understand more about project management. And from my perspective, project managers are placed in a leadership position. So we have to not only understand how to manage projects and coordinate, integrate, but also to lead teams and motivate teams and really work with the teams to create value, not only for the customers and the clients that you're working with, but for your organization also, and hopefully to create value for yourself, for your own personal brand. So the first part of this is to examine questions, analyze the questions that are being asked of you, and so we're going to give you some tips here about analyzing those questions. First of all, it's absolutely important for you to ensure that you understand the question. Now, this is probably one of the most important parts of getting ready for the exam. Read the question thoroughly. Do not scan and think that okay, I got it and I can answer the question. Scanning is generally associated with missing some keywords, and those keywords would be those that are listed on the slides: not, except, typically, generally, all, none, or even you'll see all of the following are true except, or all of the following are false except. So you have a number of types of questions that you really have to read thoroughly. And then ask yourself, do I understand what the intent of the question is? Is it a situation? Is it an actual problem that has to be solved? Maybe it's an equation, but make sure that you really understand the intent. Now, in some cases, the question might appear to be something that requires you to calculate something. However, that's not what the actual question is. So you have to really pay attention to the questions. And then, of course, distinguish between the important information that they are providing and all of that extraneous or distractor information that is often put into a question to kind of start to move you in a different direction. Okay? So we just want to make sure that you really understand that issue of the extraneous information. Now, you have to be able to disregard the information that's not relevant. There could be statistics, there could be numerical data, and it is the way they phrase these things, it actually seems like it's important, but it may not be related to the actual question. During your analysis of the question, determine if a calculation is actually required. It may not be a calculation, it might be more of an interpretation. Now, some questions may seem to suggest that a calculation is necessary, but there are no calculations. Again, it's how you interpret the data and use that information to actually answer the question that's being provided to you. Now, if a calculation is required, you have to ask yourself, well, what am I calculating? What's necessary here? Is it a cost variance or schedule variance, earned value type question? Are we looking for the profit in an incentive type of contract? One of the formulas that you'll see in the PMBOK guide is the number of communications channels that exist on a team. Are we doing some type of a decision analysis and have to calculate expected monetary value of a particular decision that might be made? Or is it something to do with estimating work, either cost or time, using the 3-point estimates we know as the PERT weighted average estimate or the triangular estimate? Now, it's important, and I think this is, again, one of those things that as you practice for the exam, you should get used to this and do this on your own, but review the data in the question, and then you will be able to use scratch paper, note paper during the exam. Make sure you ask for that paper during the exam, and sketch out the diagram or the information to give you a clearer picture. Now, let me give you an example of what we mean by that. Okay, so here's your situation. Now, if you have a piece of paper handy or you want to sketch this out, this will help you to understand how this works. So this is a type of a decision tree question. Now, if it says here, if you choose an aggressive schedule there is a 20% chance of losing $100,000 and an 80% chance of generating $20,000. If a conservative approach is taken, there is a 90% chance you will not generate any revenue and a 10% chance of generating $10,000. What is the expected monetary value of both approaches, and which is the best approach? Now, you'll see that that's in a paragraph, and in these types of questions, reading that in a paragraph and trying to figure out the answer is actually kind of difficult, and it's actually more effective if you used a diagram, a decision tree. Now we have a poll question here, and I'm going to ask Kay. Kay, could you bring up that poll on this particular question?
Sure, I'm launching that now, Frank.
Great. Okay, and the question is, based on the decision tree, which schedule approach would be best? So we have opened up the poll, and you have an aggressive schedule and you have a conservative schedule. Okay, and the probability in the aggressive schedule is 20% probability of losing $100,000 and a probability 80% of gaining $20,000. Okay, on the conservative schedule is a 90% chance of not making any money at all and a 10% chance of making $10,000. So considering all that information, which schedule approach would be best? So Kay has the poll open, so we want to take a look and see what exactly is happening with the poll. So Kay, can you take a look and see what's happening?
Sure, I'm going to close the poll. It looks like most of the votes are in, and we should see the results. And the results are being shared, and you can see that it was a 50-50 tie. It looked like 50% of the people went with the aggressive schedule, and of course the remainder went with conservative, which I think is very interesting.
That is interesting. So let's put up the answers here now so that we can see how this actually works out. And by the way, one of the things that you should really keep in mind is that you will probably see a question like this on the exam. So let's take a look and see how this all works out. Okay, the expected monetary value impact on target budget for the aggressive schedule is actually a minus $4,000, and the expected monetary value for the conservative schedule is actually $1,000. That means that those of you that picked the conservative schedule are correct, because you have a chance of making $1,000 in that particular decision as opposed to losing $4,000 in the aggressive schedule. Now how we get that is that we multiply 20% times the minus 100,000 gives us a minus 20,000, and we multiply 80% times plus 20,000, which gives us a plus 16,000. But if you subtract, actually if you add minus 20,000 to plus 16,000, you're left with a minus 4,000. And you can see on the conservative schedule that the 90% times 0 is 0, and the 10% times 10,000 is 1,000, which means that in this particular example, the conservative schedule is your best approach. Now this is important, and remember this, and if you take a look in the risk management section of the PMBOK, you will see a very good example of a decision tree that will help you to analyze and figure out the best way to do a decision tree type of an example. And you can see that drawing this diagram out on a piece of scratch paper will help you clearly see what it is that you have to calculate. So hopefully that was a useful example, and we're going to continue on with some additional examples. Now, some questions will require the use of 2 or more formulas, and I refer to these as compound questions. And I will have a few examples of that coming up. But as an example, you might need to know, or you should know, the formula known as the PERT weighted average formula, and also the formula for standard deviation. They are sometimes used in connection with a particular question to drive towards the answer. Now, I'm going to give you some examples of that. Also, many questions will be situational. Now, this, I think, is a very good way to plan these types of questions. Before reviewing the answer, consider what the question is asking, and then think about what you would do. What would you think is the most appropriate response? Now, try not to look at the answers at first. Try to think of the correct answer before reviewing the actual answers. Now, that's where your experience kicks in here. Okay, if you have experience and you've seen a situation similar to that, and you formulate in your mind that this is the answer, and then look at the actual answers you will see that there's probably one answer that is very, very similar to your response to the situation, and that is most likely going to be the correct answer. Again, all based on your experience. So that's a very good strategy. Now, one of the reasons that we're doing this webinar is to help you prepare for the exam, but you also have to realize something. Okay, the exam is a 200-question multiple-choice exam, and it is for 4 hours on a running clock. Now, the thing that you have to be aware of is if you take 200 questions and you look at it in a 4-hour window, what you have is about 1 minute and 11 seconds per question. Now, that means that you really have to get used to reviewing the question, analyzing the question, and then answering the question in 1 minute and 11 seconds. And that's just to make the 4 hours. So if you dwell on a question more than a minute and 11 seconds, you start to cut into the time that you'll have on other questions. So it's really important to condition yourself through practice, and that's why we're presenting some of this information for you. Now, make sure you review each answer. Even if you think you know the correct answer, in some cases one answer will seem to be more correct, okay? So select the one that really addresses the question and provides a good, satisfactory answer. Now, another important thing, and you probably see this in a lot of the PMP exam review books, is that some questions will be very lengthy in terms of information, and they will probably include with them some unnecessary or distracting information, something that will is extraneous to the actual situation. But you do have to read the entire question, but many people will tell you pay attention to the last few sentences. The actual question is often found in these sentences. So again, there's a test-taking strategy that you really need to think about here. Now, for questions that seem to have more than one correct answer, compare the question and the answer. Okay, is there some connection between the question and the answer? Look for words that link the answers together. Look for some way that the answer and the question are somehow connected. Don't speculate. Don't add more information. Don't try to guess. Are they holding back something from me? The question has everything in it that you need. Many people start asking the what if and speculate, and you want to stay away from that. Only use the information that's provided in the question. Okay? And then, of course, the PMP exam questions are not specific to any industry or organization. They are based heavily, I'm not going to say 100%, but heavily based on what you'll find in the PMBOK, in that the PMBOK addresses questions that are generally considered best practice. So while you're taking the exam, it's best not to answer the questions from your own specific organization's point of view and methods and procedures, but to kind of step back and think of project management in general terms. What would most project managers do in this particular situation, or what's the most appropriate action to take, considering that this is very high level and based on best practices. Okay? Now, we're going to take a look at some formulas, and shortly I'm going to hand this off to Kay, who will explain some details about some of the cost of money type of problems that involve what we call economic models. But the formulas, the weighted average formula, also known as the PERT or beta distribution formula, the time estimate is your optimistic plus 4 times the most likely plus the pessimistic divided by 6. We have triangular distribution, which is basically an average. It's optimistic plus most likely plus pessimistic divided by 3. Now pay attention on the exam. They have to be very specific here. Are we going to be using a weighted average, or are we going to be using triangular distribution? This is something that you have to make sure you understand in the question. You also have to be aware of the standard deviation, which is not mentioned in the PMBOK, but is definitely going to appear one way or another on the exam. And the formula that is acceptable for use in the exam for standard deviation is your pessimistic minus your optimistic divided by 6. And you can reference the formulas for weighted average and triangle distribution on pages 171 and 206 in the PMBOK guide. Now these two formulas are pretty important. They'll probably appear on the exam along with the standard deviation formula. So make sure that you're aware of them. Okay, now here's something else that is not in the PMBOK that you need to be aware of. And this is in normal distribution, and we know this from statistics. that 68% of the results will fall within 1 standard deviation from the mean, 95% of the results will fall within 2 standard deviations of the mean, and 99.73% of results will fall within 3 standard deviations of the mean. Now, I tell people in the PMP classes that I teach that this is something you have to pretty much memorize. 68, 95, 99. It will be a factor for maybe 1 or 2 questions on the exam, and I will, again, provide you with a couple of examples to show you how these can be used. But make sure that you note 68, 95, 99, normal distribution, and the distribution from the standard deviation from the mean. Okay? Very important. Now, this is in the PMBOK, page 292, and this is the communications channel formula. Now, the formula is the number of channels equals n times n minus 1 divided by 2, where n is the number of people. Now, the important thing to remember, okay, very important thing to remember here, is the way they ask the question. Example, if you are managing a team of 10, then the formula would be 11 times 11 minus 1 divided by 2, because it's you plus 10 people that make up that network. If you are part of a team of 10 or included in a team of 10, then it would be 10 times 10 minus 1 divided by 2. So you can see that if you're not paying attention to how they're phrasing the question, you could easily think you got the question right when you make your calculation, but you actually made an incorrect calculation by not using the correct number of people. So that's very important. So keep that in mind, and this is another formula that you have to keep practicing and have to memorize for the exam. Now, I'm going to turn this over to Kay in just a minute to talk a little bit about some of the economic models. But I want to make a point here. Okay, these are not mentioned very well. Actually, they're mentioned very briefly in the PMBOK, but not explained at all. We have present value, also known as discounted cash flow. We have net present value, which basically is telling you how much money you're going to make on an investment. We have something called break-even analysis, which is associated in many cases with whether you should make or buy something, rent or lease something. You also have payback period, which is the time it will take, not considering the time value of money, to basically recover an investment. We have internal rate of return, which I think some people refer to as rate of return, okay, or ROI, return on investment, which is the actual percentage that you're getting back. And then we have benefit to cost ratio, meaning that you have to compare the cost of an endeavor to the benefit coming back, and of course the greater the ratio, the better. Most of these are not mentioned at all in the PMBOK, all of which you should take the time to study in a little bit more detail. And with that, I'm going to switch this over to Kay, who is going to provide you some information about time value of money, present value, net present value, and so on. So Kay, I'm going to turn it over to you.
Okay, Frank. Some of these economic formulas involve the time value of money. So your money grows when compounded at an interest rate or inflation rate. So for example, if you take $100 to the bank and they give you a 10% interest per year for 2 years, how much money do you have in the end? So I'd like to have us take a poll and get the input from our audience to see if they might already know the answer. Frank, can you control that poll? Actually, if that's not ready at your fingertips, I think I can run it from here. Oh, there we go. Okay, so the poll question is the same one I just posed. If you have $100 and invest it at a 10% interest rate, how much money will you have in 2 years? Will you have $100, $110, $120, $121, or $130? See what the audience thinks. I see some votes are coming in. You can close the poll when you're comfortable there, Frank, and show us the results. I think most of the answers are in, so why don't we close that? And there are responses. Most of the people thought that the answer was $121, and that answer is correct. We'll hide that and go back to our slide. And if you present the next slide, Frank, we'll show you why the correct answer is $121. And the answer is it involves compounding. The first year you have 10% interest gained on $100, which is $10. The second year we have $110 plus 10% more gained, which is $11, giving us a total gain of $21 over 2 years. So that's why the future value of our $100 is $121. So our project financial calculations need to consider this time value of money. The formula to calculate the value of money in the future is this: the present value times 1 plus the interest rate, where the rate of 10% is presented as 0.1, to the power of the number of years involved. So Frank, if you will present the next slide, we'd like to talk about exponentiation. A few formulas that you'll need to know, including the future value of money and the present value of money, require this exponentiation. And the exponent is shown in mathematical formulas as a superscript. And it's usually slightly smaller and offset by about 30% visually to the upper right of the number. And in this case, the exponent is the number 5. And it's often verbalized as 4 raised to the 5th power, or 4 raised to the power of 5, or sometimes it's stated as to the 5th degree. So these all mean the same thing. And the 4 raised to the 5th power would be calculated like you see here. It's calculated manually on the calculator as 4 times 4 times 4 times 4 times 4. And if you calculate that out, the answer is 1,024. So that's exponentiation. The present value calculation is used to determine the potential value of an investment by adjusting the future forecasted value to its value to us today. So this formula uses similar acronyms and exponentiation to the future value calculation we just did. Here is how the formula translates to English. It's the present value equals the future value divided by the sum of 1 plus the inflation rate or interest rate per period. And so n is the number of periods. Usually it's in terms of years. So as we take a look at this question that says, what is the present value of $1,000 received 7 years from now, assuming an 8% inflation rate? So if you click ahead, Frank, we'll show them a timeline view of what this would look like, which is showing the $1,000 7 years off from now. And now is indicated with a 0. And then, Frank, if you click ahead, we'll use that formula to get the present value, showing that we would divide $1,000 by the 1.8 to the 7th degree. And that means 1.08 times itself 7 times. And that gives us approximately 1.71. And when we divide that 1,000 by 1.71, we get $585. So if you click ahead, that shows the answer. And so that's how we work it backwards. And let's move on to look at a slightly more difficult example. So sometimes the question of present value is more complicated because of the annual cash flows. So for example, Frank, if you click and add our question, if you were given this question, what's the present value of $200 per year for 7 years, assuming the inflation rate is 8%? Well, here we have to factor the inflation against the income each year. Since the exponentiation on a manual calculator takes some time, I recommend that we build those yearly factors in one building step at a time. So the first year, the factor would be 1 plus the interest of 8%, which is 1.08. And then we take that to the power of 2 for the second year, which gives you 1.17. Add 1 more power to that, meaning times that by 8.08 again for the third year, which gives you 1.26. Adding 1 more power to that for the fourth year, you would get 1.36, and adding 1 more power to that for the fifth year, which would give you 1.47. Again for the sixth year, which gives you 1.59, and finally 1 more power of 1.08, giving you 1.71 in the 7th year. After you have this divisor for each year, you use the present value formula to determine what this inflation devalued cash flow will be. And so, Frank, if you click again, thank you. It shows the first year's 200 value is reduced by 8%, which is $185. The second year's $200 value divided by 1.17 is $171. And each following year, the inflation reduces the value of the $200 even more. Until 7 years later, the $200 of cash will only have a present value of $117. So to determine the net present value total, we add them all together, and then we get the final answer of $1,041. So let's move to the next slide then, which is explaining that in project financial models, it isn't just the present value of cash flows, it is the net present of the project that we're calculating, factoring in our expenses. So this is the most common method used in evaluating investments. Net is the part that really matters. Some call it the bottom line as opposed to gross value. Typically, a company will have multiple investment opportunities. Selecting the highest net present value projects, NPV, will maximize the company's and the shareholders' wealth. And so we need to remember that if the net present value is greater than 0, the investment will earn a return, make us money. If the net present value is less than 0, that investment will actually lose us money. So let's proceed to a sample problem. Okay, as we work through this sample net present value problem together, let's look at this question. Your company is considering the purchase of new machinery to reduce operator costs. The cost to purchase and install the machine is $90,000. After that investment, the cost savings are projected to be as follows. Again, in the first year, we're going to have a cost of $90,000, but after that, in year 1, we're projecting a savings of $20,000, year 2, and years through 5, we're expecting to get a savings of $40,000 more per year. So the question is, assuming the cost of money is 10% annually, what would be the net present value of this project? So if you proceed to the next slide, we'll kind of show you how you might visualize this answer. I would start by drawing out 5 years on a timeline and indicate that the $90,000 investment occurs at the beginning, or in year 0, as shown here. Then we indicate the savings above the line of the planned cost savings of $20,000 at the end of year 1 and $40,000 at the end of each of the following years. So let's add the interest or time effect to these forecasted savings. If the interest rate is 10% per year, it doesn't affect our initial investment of $90,000, but after that, time starts passing, and we calculate each year's effect by the number of the year plus the interest rate to the power of the number of years. For year 1, that factor is 1.1. For year 2, it's 1.21. For year 3, it's 1.31. Year 4 is 1.46. And for year 5, it is 1.6. When you convert each year's present value formula with these factors, you get the dollar present value, which turns the first year's $20,000 savings into an $18,000 200 savings. The second year's $40,000 savings turns into $33,000. The third year's $40,000 savings into $30,500, and the fourth year's savings of $40,000 into $27,400, and the fifth year's $400,000 savings is just $25,000. So let's look at that alternative table format in the next slide. So this is showing you another way that you might just calculate the same problem, and you want to remember that the future value formula is the present value divided by the factor of 1 plus the interest rate to the power of the number of years. So that factor for each of these years is shown, and you might calculate your answer giving you the same result just in this table format. So same result being a net present value of $44,100. So now Frank will discuss some earned value formulas.
Okay, thank you, Kay. So hopefully you got some useful information out of that. I would suggest that you practice your present value formula, your future value formula. We are inclined to believe that you will get a few questions on the exam involving those particular formulas, and it is a good idea for you to keep practicing. Now, as far as earn value, okay, and I'll have a question for you in just a minute, but when it comes to earn value, years ago, the acronyms that were used were slightly different than the PMI acronyms that we're using today. But I think it's important to actually be able to interchange either set of acronyms. And I'm going to explain that in some detail here. Okay, first of all, this is kind of a memory jogger, and one of the things that Kay and I are always telling people when it comes to the PMP exam is that when you get to the exam site and you are finally registered in and you're at your position and so on, maybe you've taken the tutorial on how to use the computer and all the different options that you have available. So get yourself a piece of scratch paper and to do what we call a mind dump. And I think a lot of people have probably told you that, do a mind dump. Now, that means writing down as many formulas as you can, things that you remember, these little tidbits of information that are going to be important to the exam that you need to be aware of, and will also help you to stay kind of less stressed out. So this particular sheet, this slide, if you can make a kind of memorize this and place this on your dump sheet, you'll notice that the earned value is always in the left-hand side. It's a column. And we're going to start with BCWP, which means budgeted cost of work performed, which is translated to mean earned value, which means that is the amount of money that you had planned to pay for the work that has been performed or accomplished. Now what we do is we subtract from that the ACWP, the actual cost of work performed, also known by PMI as AC, actual cost, and that is what you paid for the work that you actually did. And the difference between that is your cost variance. So what we're comparing here in this first formula is your budgeted cost and your actual cost. Okay, so if your budgeted cost is 1,000 and your actual cost is 900, you subtract 900 from 1,000, you get a cost variance of plus 100. Okay? Now, the second formula is BCWP, budgeted cost of work performed, again, also known as earned value, minus budgeted cost of work scheduled. Translated, that means that is the amount of money you had planned to pay for the work that should have been done at the time of measurement. This is also known as PV, plan value, in the PMBOK. And I just want to make a special note that you'll notice that PV, meaning present value, also means PV, plan value. So you have to make sure that we can differentiate the two depending on the situation and what they're actually asking for. Now, what we're doing here is that we are comparing the amount of the budgeted cost of work performed or earned value with what you should have accomplished. So if the budgeted cost of work performed was 1,000, but your budgeted cost of work scheduled or your planned value was 1,200, it means that you should have completed work packages that would equal $1,200. And when you look at the work that you've completed, you only see that you've done 1,000. It means that you are behind schedule by, in this case, $200. That is known as schedule variance. Okay? So it's very important that you understand what we mean by these acronyms. Budgeted cost of work performed or earned value means this is what you had planned to pay for the work that has been accomplished. Actual cost of work performed, or AC, is what you did pay for the work that has been accomplished. And BCWS, also known as PV, plan value, that is what you had planned to pay for the work that should have been done at the time of measurement. Now, if we're looking at efficiency, right, we'll take a look again. On the left-hand side, you'll see BCWP, budgeted cost of work performed, also known as earned value, divided by actual cost of work performed, or actual cost, and that will give you what is known as CPI, or Cost Performance Index. That is a measure of the efficiency and how you are using your money. My example, if you have an earned value or budgeted cost of work performed of 1,000 and you divide that by the actual cost of work performed, or AC, of 900 into 1,000 will give you 1.10. That CPI 1.1 means that you are actually doing 10% better on your budget. Your project is actually under budget. And a CPI of 1 or greater than 1 is actually very favorable in terms of performance. Now, the same thing applies with the other formula, which is BCWP, budget cost of work performed, or earned value, divided by BCWS, budgeted cost of work scheduled, or planned value. Now, in our example, I said that we had a budgeted cost of work performed earned value of 1,000 and a budgeted cost of work scheduled of 1,200. If you divide 1,200 into 1,000, you will find that it's less than 1. It actually comes out to 0.84, meaning that from a schedule perspective, you're not very efficient in the use of your time, and a 0.84 would indicate that you are behind schedule. So you're not very efficient. And the next, I'm going to do a poll here just to make sure that we understand what this is all about. So let me go to the poll. Okay, could you bring that poll up, please?
I sure can. The poll is being viewed.
Okay, so give everybody a chance. And okay, I think that you should be able to see the poll questions coming in, right?
Right. People are voting very quickly, and the answer is unanimous. Everybody's paying attention, so I'm going to close it and share the results. Oh, actually, we did have a few people who disagreed, but in the end, we had 93% said superior performance, and 7% said perfect as planned performance.
Okay, so I think that you're starting to see how this all works. Now, this little memory jogger, very important for you to make a note of and to use it when you do your memory dump, your mind dump, before you actually take the exam. It's very, very useful. Now, let me just explain one more thing to you about earned value, and that is the performance index. If you have a performance index that is greater than 1, that means superior performance. So if you have a 1.1 CPI, cost performance index, you're actually doing 10% better than your budget, or you're getting $1.10 back for every dollar you spend. All right, if a performance index is 1, it equals, okay, in other words, you divide your earned value by your actual cost, you get a 1, that means perfect performance. That means that there is no variance at all. All right, and a performance index of less than 1 is indicating poor performance. Okay, that means that you are getting less than what you put into it. So if the 0.84 CPI indicates that you are getting 84 cents back for every dollar that you spend. Okay, so keep that in mind. CPI, SPI, you're looking for a 1 or better. In reality, I'm going to say that a 0.95 CPI and SPI is probably well within acceptable ranges. But if we're going to interpret data, just remember, if it's a 1, that means that there is no variance. If it's greater than 1, you're superior in your performance. And if it's less than 1, then you are poor in performance. Now, let's take a look at how earned value would appear on a chart. What we're looking at here is a chart that shows planned value. That is, again, what you had planned to pay for the work that was scheduled to be completed at the time of measurement. And what we're seeing here is a value, planned value, probably just under $50,000. Okay, so that's our benchmark. That's where we want to be. Now, if I add the next item here, which is my actual cost, it's telling me that what the completed work actually cost, the AC, is just slightly above 25. Now, important item. If you see this type of chart on the exam or something like this, they might ask you, what is the condition of the project? Now, many of you are probably thinking right now, oh, it looks like we're under budget. But you know what? You really can't tell what's going on with this project, because the only thing you do know is that you should have spent just about $50,000, and so far you have spent a little more than $25,000. But it doesn't tell you what the actual work on the project is, which is your earned value. Now if I add the third item in here, earned value, you will see that the amount accomplished is less than what was planned. So there is a cost variance between earned value and planned value. We should have done about 50,000, and we've done just less than 25,000, which is telling us we are behind schedule. And if you look at the actual cost is probably, if I was to make an estimate, is probably about 30,000, and your earned value is probably down around less than 25,000, meaning that you are not only behind schedule, but you have paid more than you had planned. So you are over budget. So the actual condition on this particular project is that you are behind schedule and over budget. So remember, if you get a question on the exam where they're showing you PV and AC, they are not actually related. The only thing that PV tells you is where you should be, and AC will tell you how much you spent. But it's earned value that will tell you how much work you have actually performed and what you had planned to pay for that work. Then you can answer the question correctly. So it's very important that you are very familiar with these concepts. Okay, so the important thing to consider is what should have been completed, and then we move on from there. Now, I mentioned a compound question, and that involves more than one formula or a lot of information that you need to remember. Now, before I give you the answer to this question, we have a poll coming up to see if you'll know what the answer is. So, as the project manager for the fusion energy project, you have developed the following schedule information for project completion. Optimistic, 10 weeks, pessimistic, 30 weeks, and most likely time 20 weeks. Using the weighted average technique, you determine there is a 95% probability that the project duration will be. What is it? 1, 2, 3, or 4? And Kay is going to put up the poll to allow you to answer that question.
Okay, so the poll is up, and it helps you address the first part of that compound question. So it's asking, with a normal distribution curve, 95% of results will fall within how many standard deviations from the mean? 1, 2, 3, 5, or 6? Answers are coming in. Also, while you're thinking about your answer to this, I've noticed in the comments that a couple of people have said that after the polls, the slides didn't reappear for them. If that's the case for you after we close this poll, would you please give us a comment back, because we'll want to be aware of that. It looks like most of the answers are in, so I'm closing that poll, and I'll share with you the results. And the majority of people said 2 deviations.
Okay, so it looks like we're going to need a little work here. So let me explain a couple of things. The first thing that you have to do in this particular question is that you have to apply the weighted average formula. Okay, so my first question before I go any further is hopefully you can see the screen. So if you cannot see the screen, let us know. Okay, Kay, can you see the screen?
I can see the screen, and I don't see any other comments from anybody who says they cannot.
Okay, great. All right, so the first thing you have to do is you have to apply what we call the weighted average formula, which is that you have to remember that you're adding the optimistic plus 4 times the most likely plus the pessimistic value, and then you're going to divide that by 6. So that's 10 weeks plus 4 times 20 plus 30 divided by 6. That actually comes up with an answer of 20. Okay, now we also have to remember the standard deviation formula, which is for the exam, the acceptable formula is the pessimistic minus the optimistic divided by 6, and that will give us 3.33. Now, we have 2 formulas in this question so far, but now you have to remember what we talked about in a normal distribution. Normal distribution, the 1, 2, and 3 standard deviations from the mean. First standard deviation from the mean is a 68% chance it'll fall within that range. The second standard deviation is 95, and the third standard deviation is 99.73. Now, when we put all that information together, okay, the answer that will come up is answer number 3, which is the between 13.4 and 26.66 weeks. So how did we get that? calculated weighted average, then standard deviation. Now, once we've calculated the weighted average, which happens to be 20, and we need to understand the answer, what we'll do is we'll take the standard deviation, 3.33, and we will add that to 20 for one standard deviation plus or minus from the mean. So 20.0 plus 3.33, one standard deviation in the positive direction gets us to 23.33. Two standard deviations from the mean is 20 plus 3.33, and then another 3.33 gets us to two standard deviations from the mean, or 26.66. If I subtract two standard deviations from the mean, I get 13.4. So that's telling us that if we remember the normal distribution, that there's a 95% chance that the result will fall within two standard deviations from the mean. We see that the answer is now 13.4 and 26.66 weeks. So again, this is one of those questions where it involves calculations, it involves several formulas, and also you have to commit to memory some of the statistics that'll be used. So it's a very important thing to remember. Keep that in mind as you're doing your study. Okay, now let's just kind of go over how all this works. All right. If we're calculating probability using normal distribution, remember that there is a 68% chance that the result will fall within one standard deviation from the mean, 95% within two standard deviations, and 99.73 within three standard deviations. Now, we also need to remember that the mean is your 50% point. Now, you'll probably see some type of a question on the exam similar to what I'm going to explain to you here. So here's our situation. We have an optimistic time of 25 weeks, a pessimistic time of 50 weeks, and a most likely time of 35 weeks. Okay, first thing we want to do here is we need to calculate our weighted average. Okay, the PERT weighted average, if we use the optimistic plus 4 times most likely plus pessimistic and divide that by 6, we get the 35.8, which I rounded off to 36. Now, one standard deviation from the mean. Now, in order to calculate the standard deviation, that's your pessimistic minus your optimistic divided by 6. Okay? Now, standard deviation, using that formula, which you'll see in the textbooks, is shown as B minus A divided by 6, or pessimistic minus optimistic divided by 6. You'll see that the standard deviation is 4.17. So, one standard deviation from the mean is 36 plus 4.17, or 40.17, and 36 minus 4.17, or 31.83. Now, remember, there is a 68% chance the project will complete between 40.17 weeks and 31.83 weeks. What is the probability that the project will complete in 40.17 weeks? Now, that means one standard deviation from the mean in the positive direction. In order to come up with the answer to that, we take, remember, 68% is divided by the mean. So there's 34 on the minus side and 34 on the positive side. If the mean is the 50% point, and we add 1/2 of 68, which is 34, we get 84%. So the answer to this question is that this project has an 84% chance of completing in 40.17 weeks. And again, these are things that you do need to know for the exam. They are not explained in the PMBOK. You would have to go to textbooks and other books that explain these kinds of things in helping you prepare for the exam. But my personal experience tells me that it's very likely that you will see one of these types of questions on the exam. Now, another compound type of question involves figuring out the cost of a project. Okay, and now in this particular question, you'll see, referring to the table, what is the cost of completing this project in 11 days? Now, most of you are probably going to start guessing on this, but I'm just going to offer a suggestion. Before you try to guess, the first thing that you should do on this is use your sketch paper, your scratch paper, and draw out the diagram, this network diagram, and calculate what the project total duration is. Now, if you do take a minute to do that, you'll see you have 5 tasks. Okay, you have the durations and you have the predecessors established. It should not take you very long to actually draw the diagram and come up with the fact that this particular project will take 11 days to complete, right, based on the information provided under normal conditions. So what we have here is a project that takes 11 days. It has 5 tasks, and the normal cost for each task is displayed. So what we will simply do is that we're going to add up the cost, the normal cost of each one of these activities. Okay? Now, that will give us $6,500. So I say the question is a little tricky because you have to identify the critical path to determine the actual project duration, or verify that it is in fact 11 days. The critical path is A, B, D in this example. And then add up the normal cost for each task. The sum of all the tasks is $6,500. So under normal condition or planned conditions, it's $6,500. Okay, now, we're going to go to another question that's a little bit more complicated here. Okay, and this addresses what is called crashing. Now, you're referring to the same table. If I look back, okay, this is the same table as the previous example, except that what is the cost of completing this project in 7 days? Now, you already know what the critical path is because you just calculated it. But in this case, we have to crash the schedule. We are going to we'll use a form of schedule compression called crashing. And it tells us that we can crash A, a maximum of 1 day at $300. B, we can actually maximum crash that for 2 days at $200 a day. C, for $300 for 2 days. D is $100 a day for 1 day, and E is $100 a day for 1 day. Now, if you remember in your studies, compressing a schedule using crashing means that we should definitely focus on the critical path first. In this particular example, you have to crash all of the tasks on the critical path, meaning A, B, and D. Now, if you add the crash costs together, you will see that A is $300 in addition, that you can crash B by 2 days for an additional $400, and you can crash D 1 day for $100. We add that up, but we're not done yet. Now, most of you are probably thinking, okay, well, I did get it down to 7 days. However, if you did crash all of the tasks on the original critical path, you will realize that a new critical path has appeared, okay, and that particular path is now 8 days. And we now have to crash some more. The rule to follow in crashing is always crash on the critical path, and number 2, always go for the least cost on the critical path. Now, you have a choice to make in order to complete this particular problem. Now, what we have to do here is, again, you have your critical path. You're going to crash on the critical path first. You're going to crash each one of those items according to the table. Okay, remember, it's A, B, D was the original critical path. You're going to add up the crash costs to that. And then you notice that we have a new path, A, C, E, which is now 8 days. And we need to crash one of those. If we crash E 1 day for $100, it will reduce the total project duration to 7 days. We add that all up together, and we get a total of $7,400. Now, I mentioned this lots of times in class. It is likely that if you experience a crashing example on the exam, when you have crashed the critical path, it is entirely possible that you will have created a new critical path. So don't think you're done yet until you have checked out all the other paths and have made the appropriate additional crashing as required to get you to the amount that you're looking for. Okay, so it's very important, again, read through, follow all your paths, then validate all of your calculations. Okay, so this is a good example of a crashing question that's also kind of compounding because you have to do multiple things in that question. Okay, so you're going to crash A, then you're going to crash B, then you'll crash C, and then you're going to crash E. Okay, and that's how that works. Okay, now, here's a question for you. A project manager performs earned value analysis using the following information. The actual cost is $220,000. The planned value is $250,000, and the earned value is $220,000. Which of the following is true? Now, if you're looking at this and you're starting to get the hang of earned value, you will notice very quickly that your AC Okay, your AC is 220,000, and your earned value is also 220,000. And you notice that if you subtract 220 from 220, you get 0. So your cost variance in this case is 0. There is no variance. Okay, and you'll notice that they're trying to trick you with a CV of 1. They're trying to see if you're paying attention here as to whether or not you're thinking CPI or cost variance. In this case, the answer is there is no variance. Correct answer is number 1. Okay, now there is something in the PMBOK that you should be aware of. It's called the 2 Complete Performance Index. There are actually 2 formulas there, and it's very, very important for you to go and review those. These particular items were added, I believe, in the 4th edition of the PMBOK, and my basic rule here is when they add things to the PMBOK, you can pretty much expect them to be on the exam. So let's take a look at 2 Complete Performance Index. What this means is that if you have a certain performance level and you are not going to make your target, what this means is that you have to increase your performance level in order to achieve the target. In this particular example, what we're saying here is that management is telling you that your budget at completion, your budget for the project must be achieved. In other words, they're not going to give you any more money. So our project data is this. Our BAC, which is budget at completion, is 250,000. Our CPI, Cost Performance Index, is a 0.85. Our Schedule Performance Index is a 0.90. Our earned value is 50,000, and our AC is 59. Now, that information alone, if we analyze that, okay, if your CPI is a 0.85, you know that there's a problem. It's less than 1. You also see that SPI is a 0.90. However, this is a 2 Complete Performance Index that is dealing with cost and not schedule. Okay? So that particular 0.90 is not relevant for this question at this time. Now, your earned value is 50,000 and your AC is 59, which means that you spent more than you had planned to spend. Now, if we apply the formula of BAC minus EV, which is budget at completion, minus your earned value, divided by your budget at completion minus your actual cost. Okay, what that means is 250 minus 50K divided by 250 minus 59, which is 200 divided by 191, is telling us that in order for us to get to where we need to be, that we need to improve our performance index to a 1.05. Remember, the current CPI was a 0.85, so what we have to do is we have to improve our efficiency from a 0.85 to 1.05. Sometimes that's possible, and sometimes that's very, very hard to achieve. But again, my suggestion is go to the PMBOK. Okay, this is in the cost management section near the very end of the chapter, and take a look at the formulas for TCPI. There are 2 formulas involved. One when you must make the BAC, the budget at completion, and also a formula when you cannot make it, when it's going to be impossible, and then you have to actually calculate the estimate at complete, which would become more of a compound question because now you have to remember the formulas for calculating EAC in order to complete the question. So again, it requires some study, some practice, and reviewing the information, but not only in the PMBOK, but you have to review practice questions to really understand and get to use this and really know the formulas. Okay? Now, it's another type of formula. Actually, yes?
I'm going to jump in here. Everybody probably knows that you're used to training and presenting webinars alone. And and you're very expert at it, but I'm going to jump into this slide if you don't mind.
Absolutely.
Excellent, thanks. So the next calculation that we're going to address here is related to procurement, and it's a calculation involving an incentive contract, specifically a cost plus incentive fee. And incentive contracts have targets, and sometimes there are cost or profit incentives. Sometimes there are schedule incentives or penalties. Sharing ratios help motivate contractors to share common goals with the buyer. And here's an example problem for that. So let's say that you are closing out an airport renovation project. The contract is a cost plus incentive fee contract. The target cost for the project was $200,000 with a 10% target profit. The project financial data indicates that the project was completed at a cost of $180,000, so completed under the expected cost. The sharing ratio for the project is 80-20. So the question is, what is the final price for the contract? And this is a good problem to take Frank's earlier advice and pay special attention to the end part to carefully determine what is the question we're trying to answer. We don't know if we're the buyer or the seller here, but here's how you might logic through this calculation. So Frank, if you'll click on the next slide. First, we want to calculate the target cost. Since the situation said it was $200,000 plus a 10% target profit, we add the 10% profit of $20,000 onto the cost, giving us a total $220,000 target. It says the project's tracked actual cost was $180,000. The seller would still get the $20,000 fee for their profit, bringing the amount prior to the incentive up to $200,000. On top of that, the sharing ratio of 80-20 always indicates the buyer percentage first and the seller percentage second. The cost savings was $20,000 since 20% of $20,000 is $4,000. The seller also gets that incentive or bonus for coming in under target. So the contractor would get reimbursed for cost plus the $20,000 fee plus the $4,000 incentive. So this incentive contract has a win-win, reducing the overall price for the buyer and increasing the profit for the seller too. So let's move on and explore a problem requiring a calculation of expected monetary value. So next slide. Thanks. So this is very similar to the calculation of decision trees, which Frank covered earlier. This scenario says that your project team has a choice to make between two projects, alpha and beta. So it says that choice alpha has a 20% probability of losing $50,000, but an 80% probability of gaining $20,000, whereas choice beta has an 80% probability of losing $40,000 and a 20% probability of gaining $200,000. So the question is, what is the expected monetary value of each and which choice should be taken? So we are given four possible choices there. And if you'll click ahead, Frank, then we'll show how we would calculate this. So the way that we would come up with our solution is that we would take the probability of the 0.2, 20% of the alpha project losing $50,000, and we would add to that the probability of 80% that it would gain $20,000. So that ends up being the 20% probability times $50,000, negative $50,000 is a negative $10,000 plus the $16,000 if it is a success. So that alpha ends up having a value of $6,000. The beta project, on the other end, we take the probability of the 80% of losing $40,000 plus the 20% probability of gaining $200,000, and then that mathematically works out as taking the sum of negative $32,000 plus $40,000. So our beta project has an expected monetary value of $8,000. So if we look at our choices in that selection, the third answer is the correct one. So we picked the beta project because $8,000 is greater than $6,000. I want you to remember that the expected monetary value, that we want the project always with the best overall probability of the greatest gain. So that's how we would calculate that out. And that actually is the end of our sample formulas today. And as we wind down, I want to reiterate something that Frank had stated earlier about the importance of taking a lot of practice questions and practice exams. Frank and I have created a very helpful online practice exam site, and it's available to 2 subscribers as a 6-month subscription for a one-time fee of $25. So if you're interested in that, and we hope you might be, we would ask you to go to www.successfulprojects.com for more information on that and click to how to subscribe. And then, Frank, if you'll progress to the next slide, I just want to quickly show our viewers the different types of mock exams that you might practice in different ways. So this may be difficult for you to read, and you don't have to read it all. It just is showing you here a couple of the different ways that exams are presented in this. The first exam listed here is like the full hour PMP exam. It defers feedback to the end. It really is a good thing to do at least once right before you sit for your actual exam, because it ensures that you are practicing in the way that the test is actually presented to you. The second exam on our list here is like the first in that it randomly selects 200 questions from our database of many more than that. But in this exam, the feedback on the questions is immediate, so it can help you in your learning process. It explains why the right answer is the right answer. The third exam is 10 random questions in 10 minutes. It's really good for short study breaks. It helps you get used to trying to pace yourself at about the 1 question per minute, or I think, Frank, you said it was 1 minute and 11 seconds per question. In the exam, you'll want to try to make sure that you are working through at about that pace. The fourth exam on this list focuses just on the formula questions, so things like we presented today and more. Other exams focus on just the most difficult questions in our database, and there's many more than what are shown here. So we've worked with many PMP students for many years, and the utilization of practice exams is often the top recommendation from students and instructors alike. So back to you, Frank, for our summary.
Okay, thanks, Kay. I get carried away sometimes. You have to forgive me on that. I get really excited doing this stuff. And you know what? I've done it so many times and for so many years, and people say, don't you get tired of this? And to tell you the truth, no. It's kind of fun. I like to find different ways to do it, but sometimes I just get so engaged in it. And I hope that everybody that's listening can hear that we really, Kay and I, are very, very passionate about doing things in a way that'll help people pass the exam and learn more about project management. So, you know, it's a good kind of exciting way to do things, you know, and the passion is there, and we really appreciate you being here with us. For those of you that are looking for PDUs, there's 1.25 PDUs. It is a category PDU, which means you have to go to the PMI website, click on the category B, and then just type in Project Management Formula Review, Successful Projects, La Crosse, Wisconsin, and so on, and you'll get your 1.25 PDUs. So remember, category B. Also, keep in mind, you know, we just finished up International Project Management Day 2014. November 5th, 2015 is International Project Management Day. We're doing our best to keep the website updated. We're going to add more information. We're looking for volunteers that will help us out with that. But you can visit www.internationalpmday.org for more information. This particular webinar has been recorded, and it will be posted on that website for you to review again if you want to. Tell other people about it. We really like helping people get ready for the exam, and also, like I said, to help people prepare more for just being better project managers. And hopefully you enjoyed the webinar. If you have any specific questions or inquiries, you can send them to me, salatispmp@msn.com. And I mentioned earlier that this is a complimentary webinar, but we are looking for ways to build the programs and things like that. So if you feel inclined to do so, if you feel that you got at least $5 worth out of this particular webinar, you can send a PayPal payment to Blue Marble Enterprises. The email associated with that is salatispmp@msn.com, or you can send a check to Blue Marble Enterprises at 97 Mountain View Avenue, Staten Island, New York, 10314. And what we want to do also is, there was a question earlier, will you have more webinars? And yes, Kay and I are planning to do a lot more webinars throughout the year, and we would like your feedback on subjects. We plan to do a few more of these PMP type prep webinars with different types of questions, situational questions, more formula questions, things like that that'll help you out. We also, like Kay mentioned, encourage you to maybe try out the mock questions that we have available online. hopefully you get some real value out of the session today. And we only have another minute or two before we're going to wrap up here. So I'm just going to take a quick look and see what kind of questions we might have. I noticed that we had people from Canada, from Brazil, from Athens, Greece. Exciting that you were here with us. Really appreciate it. Let's see, we have somebody's taking the exam on January 14th. Okay, that's Julius. And he has some knowledge gaps that we have helped fill in. That's great. He says, great job. Remember the email, salatuspmp@msn.com. Marco says, please correct the email information in PayPal. Okay, I better take a look at that. January 14th, another one, somebody's taking the exam on January 14th. Who is that? I think it's Reggie something. Okay, well, good luck, and you have my email. If you have any questions or last minute items for the exam, send me a note, see if I can help you out. John is in Florida. It's 70 degrees down there. It's only 39 here in New York City. Somebody said this was awesome. Do you have anything specific to CAPM? Okay, this is Christine. CAPM. Okay, my suggestion on CPM, number one is you do have to read the PMBOK. The major difference between the CAPM and the PMP is that the CAPM exam, which is an hour shorter and 150 questions, is really about, do you know what these terms are? Do you know what these tools are? And you have to kind of put yourself in the position of helping a project manager. So you will not have a lot of what we'll call situational questions, but you will get questions that are more associated with definitions and also, which type of tool to use when, that kind of a thing. So you would have to spend some time, again, reading the PMBOK and reviewing not so much situational questions, but kind of picture it this way. You have, the PMBOK provides you with what we'll call like a toolbox of things that you could use on your projects. And what you have to be able to do for a CP, to be a certified associate project manager, is be able to open up that toolbox and see all the different tools and pick out the right ones that would be used for a certain situation. So your goal is to make sure that you can differentiate one tool from another, how they're used, and so on, and spend more time focusing on understanding their use and making sure that you're applying the right tools. Whereas the PMP exam is more situational, and you are the project manager put into some type of a situation, maybe it's a crisis, and they're going to ask you, what will you do? Which means that there are decisions to be made here about which approach to take. Whereas the CAPM is more about, do I know what tools should be used? And if a project manager said to me, I need help in constructing a WBS, you would have to know that. That if you were going to be involved in estimating, you would have to know that we have estimating techniques such as the weighted average estimate and the triangular estimate and so on. That's what you would need for CPM. So hopefully that answers some of your questions. Okay, Julia says this was awesome. Thank you very much. Very useful, sunny Florida. Okay, so I think that we've answered your questions. Let's see what it says. John Watson says, come and visit. Hey, John, I will definitely want to come down there. Florida is one of my favorite places. Chris says, thank you, Christine. Thanks from Tom in Florida. Happy New Year to everyone. Tomorrow is New Year's Eve. Don't party too much and can save some of those brain cells for the exam. Okay? So, hey, Kate, any last comments before we close out?
Oh, no, Frank, I just want to thank you. Your enthusiasm is very infectious, very positive, and Happy New Year to you and all of our listeners.
Oh, boy, okay. Maybe I'll start the new year early. No, I won't. I'll wait one more day. Okay. Have a nice 2015. Thank you very much. I don't see everybody's full names here, so forgive me on that. Christine, someone named Geraldine. Oh, Geraldine, hey. Thanks so much. Come back to Med Council. Absolutely. Bring me back. I'd love to go back out there. I think Alex says Happy New Year. Tom says Happy New Year. Thank you very much, everybody. Appreciate it. Let me stop the recording, and we are going to sign off now.